Hello and welcome to this special programme on December's US jobs report. The headline non-farm payrolls figure is expected to come in at 164,000. We'll also be paying close attention to any revisions to last month's reading, which came in at 266,000 for November, beating expectations and marking the highest advance since January of last year. Meanwhile, today, December's unemployment rate is seen coming in at 3.5% and average hourly earnings are forecast to hit 0.2% month-on-month and 3.1% year-on-year. Let's have a check now on the markets as we head into those final hours of trade for the week. Here's a look at the European equity indices. We're 5.5 hours into the trading day and approaching those final hours for the week in the first full week of trade for 2020. And you can see there that it's the FTSE 100 that's marginally underperforming, down by almost 0.1%, whilst the Germany 30 cash, or the DAX, is up by just shy of 0.25%. Here's a check on pre-market action in the United States as we await the equity market open in just over 1 hour's time. We can see there that the US Tech 100 cash, or the Nasdaq, is the outperforming ahead of the market open, up by 0.37%, while it's similar gains for the Wall Street cash and the US 500 cash, up by 0.12 and 0.18% respectively. And it comes after the Dow logged another record high overnight on the back of diminishing geopolitical tensions and a new high for shares in Apple. Let's have a check now on the US dollar crosses. There they are. You can see that euro dollar is a little bit lower. Same, meanwhile, cable a little bit higher and dollar yen a little bit higher as well. So broadly, we are seeing a little bit of strength for the dollar, that is, except for against the pound. But remember, of course, plenty of investors likely taking to the sidelines right now ahead of that all-important non-farm payrolls report that we're expecting at 1:30. So in just a few minutes from now. Joining me on set today is IG's senior market analyst, Josh Mahoney. Josh, good to see you. Now, on Wednesday, we had the ADP private employment report. That came in at 202,000, beating expectations, adding the most jobs in 8 months. So what are you expecting from today? Do you think that ADP number is a whisper to a stronger NFP?
Yeah, I mean, look, if you look at some of the numbers in other readings around the US markets, they have been relatively strong. Same kind of thing in terms of the claimant count, or the unemployment claims. We've been seeing around about 5 weeks now of consecutive deteriorations in terms of those claimant numbers. So that certainly points in the right direction as well. What we need to note is the fact that that last number that we saw last month was actually elevated by the fact that we saw this strike in terms of General Motors. That was around about 46,000 people. So the expectation is that that number's going to come out of the reading. Markets looking around about the 160, 164 kind of area. But certainly I think this is going to be interesting in terms of market expectation as well. We've been seeing the US dollar rising, and something I wanted to just point out to you guys here is the interest rate probability associated with the Fed at the moment. We can see here currently around about a 10% expectation of a rate hike, no change at 90%. So certainly that overwhelmingly points towards no change. And certainly that's likely to remain in play. But the figures that we're seeing, of course, if we see another particularly strong reading, like the ADP number would allude to, then you could possibly see this shift. And of course, if we see a greater expectation of a hike, you're going to expect to see further upside for the dollar. And we can see here in terms of the dollar basket, this downtrend that has been in play through the back end of 2019 really would start to come undone if we break through the 97.37 peak. And we're not necessarily so far away from that at the moment.
All right, so what's the trade then today? How should we be trading this report?
Yeah, so this dollar basket chart is particularly interesting. Like I said, 97.37. We'll look at some of the more commonly traded markets. Euro dollar, of course, is the inverse to an extent of dollar basket because of the weighting, the heavy weighting that you have for the euro within that. And we can see the wider trend, this weekly time frame, providing us with this clear bearish outlook. We have been retracing what I believe is this sell-off from 11412, and therefore there's a possibility we're going to get back onto that trend if we see a decline below this 110.67. That's the key level I think we want to look out for. It might not necessarily be broken immediately, but now that we've broken through to 76.4, that does signal a high possibility we could break back into that wider long-term trend and out of the uptrend that we have been seeing through the back end of 2019 and moving into 2020.
All right, very, very quickly before we get the numbers, it seems like the market oscillates between caring more about the headline figure when it's worrying about recessions, or the average hourly earnings when the markets are more concerned about inflation. What's the key number for you?
Certainly, look, ultimately the market initially is going to react on payrolls. It always does.
All right, I'm going to have to interrupt you. We've got the numbers there. It's 145,000 for the headline non-farm payrolls figure for December, so that's a miss on expectations. Average hourly earnings also coming in lower at 0.1% versus forecasts for 0.3%. In terms of the year-on-year figure, 2.9% versus expectations for 3.1%. The unemployment rate coming in line with expectations at 3.5%. So if you're concerned about inflation, it looks like those earnings figures are coming in a little bit softer, and in terms of that headline figure, also a little bit weaker, but not by a huge margin. 145,000 is the number we're getting there. Josh, what are you seeing in terms of the market reaction?
So we're seeing the dollar coming off, and just as we were talking about this potentially being an important point for us to maybe break through some key resistance levels for the dollar, we've got a similar kind of story in the reverse, because we hadn't yet broken through these key resistance levels, and we have certain trends that are in play. I want to point out the dollar yen chart here. Let's just look on a weekly time frame and move in. So the wider trend is clearly a bearish one. You can see since these peaks in 2015. More recently rallying back into the 200-week SMA, and you can see respecting it on a number of consecutive weeks alongside this descending trend line. Now we're seeing momentum rolling over with that stochastic just about breaking through that 80 mark. So is this going to be a reversal point? Now certainly with the fact that we saw some decent downside coming recently, we've actually broken through this 108.43, 108.23, and actually you can see it on the daily time frame. That really breaks out from the uptrend that we've been seeing out throughout Q4, and now points towards a possibility of this market rolling over. Well, of course, back end of this week, everything switched. Of course, we've got the whole Iran issue seemingly cleared up, and then we've got everyone looking forward to this US-China signing for next week. So we've rallied into, but not through, the 109.71 mark. And if we broke through that level, then it seems to negate this potential breakdown. But now that we're possibly seeing some weakness coming into play, this could be a point where we could see, if this continues to play out, some weakness from here. So certainly we have a very clear area of resistance that, if broken, would negate this idea. And given the fact that we've seen a relatively soft earnings report, payrolls report, there is a good chance that we could start to see this market roll over. Just going to quickly look at it on the 15-minute chart. We can see exactly that, seeing that relatively sharp move low and starting to take out some of these support levels on the way down.
Okay, just one more number to draw your attention to is the revision to last month's figure. So that's the non-farm payrolls number for November, which came in a little bit weaker. So 256,000 revised down from 266. Now, Josh, you mentioned the fact that those Middle East tensions have calmed down a little bit. We did see markets performing a bit better in the latter half of this week, at least so far. And it seems like sentiment is returning to be a little bit more risk on. Does the payrolls report do anything to change that?
Not necessarily from the perspective of thinking all of a sudden the US economy is amazing. It's not to say that, you know, that it's doing awfully, but certainly these numbers aren't necessarily blockbuster numbers that are going to make us feel great about the US economy. But the one thing that, you know, I've always noticed whenever you see these big ramp ups in terms of geopolitical tension, a lot of the time involving the Middle East, you need to see it sustained. Now, it's one thing if you have a protracted war, but when you've got something like this, which generally, you know, we had the sort of same kind of thing with the attack on Saudi operations, right? You see that initial market reaction where everyone thinks we're on the cusp of a war, and by and large, unless you see things on a day-by-day basis that really continue to push it in that direction, it always seems like you're on the cusp of markets forgetting about it, or it not necessarily being as relevant, or people as worried about that. That's certainly now the position that we're in, and as we move into a week where we're going to, of course, see that US-China trade deal signed, I think by and large markets are going to start focusing elsewhere and really leave that whole Iran issue behind them, unless we saw another attack, which seems quite unlikely now.
All right, I wanted to ask you about gold as well, because there's been so much talk and interest around gold, and indeed the whole complex within the precious metals. But we have seen gold come off a little bit. But today, the report, we're seeing it spike up in reaction to the weakness in the headline number. Do you think it could get back up to 1,600?
Look, I think that ultimately what we've seen in terms of the rally in gold off the back of the whole Iran issue is just the latest in a leg higher that is part of a wider uptrend. I mean, you can see this here in a weekly time frame. Certainly this period of consolidation that we've seen for year upon year appears to be over. And we can see that since the lows that we saw around about the sort of third quarter of 2018, we've been clearly trending higher. And in actual fact, each retracement within this move towards the upside has been relatively shallow. You can see here, if we were going to look at this retracement, it's certainly nowhere near your 50%, so it's going to be somewhere around your 38.2. This is probably even a more shallow retracement just because of the sizable move towards the upside. And then ultimately what we've seen at the back end of last year moving into this year is this move higher that we're currently within the move of. Now we can see here on the daily time frame that sell-off that you're talking about, the weakness we're seeing at the back end of the week, where all of a sudden everyone realizes we're not on the cusp of a major war and that they don't necessarily need to be holding gold as this massive haven move. But ultimately the trade is relatively clear, and you can see this uptrend remaining well intact until we break the 1445 level. That to me means that the downtrend or the weakness we've seen over the past couple of days is likely to be a retracement. The question mark is what Fibonacci level were we going to come into, or how deep is that retracement going to be? And that's still yet to be sorted out. Essentially, we could still move lower, but like I said, because of the fact that I see this 1445 move as essentially a retracement, I don't necessarily see that the weakness at the moment is a reason to start thinking about this market as being on the cusp of a major sell-off. I see it as a buying opportunity. Have we seen enough right now to point us in the direction of this market recovering from here? Let's just put the 50% on and see, the 38.2. You know, it's not necessarily a deep enough move for me at the moment. We are seeing some upside at the moment, so there is a good chance we could see some sort of rebound, but I am also aware that there could be another leg lower as we sort of saw maybe an ABC style retracement into a deeper Fibonacci retracement. So short term could see a bit of upside, but I still think we could roll over into a deeper retracement for gold.
All right, now throwing it forward, we've got fourth quarter US earnings season kicking off next week with a whole series of the banks, including JP Morgan, one of the first ones. I mean, what are you expecting there? Do you think that this could provide a tailwind for markets?
Yeah, well, look, I think market expectations for 2020 are relatively bold. People expect to see a resurgence in terms of earnings figures. Bear in mind that the year just gone, and certainly towards the back end of it, earnings have been more a case of can they outperform relatively low expectations. And we're moving into a year, Refinitiv talking about around about a 10% expectation across the whole market for an increase in terms of earnings. And so really we're moving into a more positive sense. Of course, we've got this whole US-China issue potentially resolved, or to some extent, that first phase deal. So I think markets are going to be looking at a bit more of a positive sense. The interesting part of that, of course, is where markets expect to see greater earnings numbers. Of course, are we then going to see the flip side of what we've been seeing at the back end of 2019, i.e. market expectations higher, and therefore that bar being higher, it's more difficult for them to actually achieve that. So that's something you should certainly look out for the year ahead in terms of US earnings.
All right, now that's all we have time for today. But before letting you go, let's have a quick recap of those numbers. It was 145,000 for the headline figure, a little bit short of expectations. Last month's reading was revised lower to 256,000. And those all-important average hourly earnings figures month on month, a little bit lighter than expected, 0.1%, year on year, 2.9%. The unemployment rate bang in line with expectations. Thanks so much to my guest, IG's senior market analyst, Josh Mahoney. And thank you for watching this special programme on the latest US jobs report for November. I'm Victoria Scholar, and have a lovely weekend.